Hi, we are back for more of class 29 on the Monday, Wednesday, Friday schedule. So this is video 29B, and we are on 21B if you're the Tuesday, Thursday classes. So we're continuing on talking about when one company invests in another company. So we've already talked about the asset of debt securities. When one company purchases debt securities of another company. And now we're going to talk about when one company purchases the equity securities. So in other words, they're purchasing stock in another company. All right. So how are investments in equity securities accounted for? Now remember, we're only going to talk about when you invest on a small percentage of another. You buy a few shares of their stock, less than 20% of that other company. Of course, companies can buy a lot of stock in other companies and even control other companies if they want, but that's not going to be the case. That's some more complex accounting. We're not going to deal with that in this class. We're just going to really talk about the cost method. So you can skip all that other stuff in the book. The accounting for equity securities must be separated into three categories based on the percentage of ownership of the investor. Equity securities in which the investor owner, sorry about that, let me just get rid of this, in which the investor owner owns less than 20% ownership in the voting stock of the investee, can be either trading investments or available for sale investments. So you buy stock in another company. Why did you buy it? You're trading, you're going to buy and sell, or it'll just be available for sale. When a company invests in equity securities with 20 to 50% ownership of the investee's voting stock, the investor can significantly influence the investee's decision, as an investor owns a controlling interest when they own more than 50%. So we're not going to worry about a significant or controlling investment. We're just going to assume that we're dealing with companies who buy some stock just as an investment that they're either going to trade or is available for sale. So we will discuss transactions for less than 20% ownership in this class. So this is what we account for these using what was called the cost method. Equity investments that are less than 20% of the outstanding equity of the investee are accounted for as either trading investments or available for sale investments. Accounting for these types of equity securities is similar to accounting for debt securities. The main difference, though, is that equity securities earn dividend revenue instead of interest revenue. So, right, because they're debt securities, they're paying you interest. Equity securities are stocks, and they may or may not pay dividends. All right, so let's look at how we book a purchase. Smart Touch Learning has excess cash to invest and buys 1,000 shares of stock in Yellow Corporation for $26.16 per share on March 1st, 2016. Smart Touch Learning owns less than 20% of Yellow's voting stock and intends to hold the stock for 2 years. So the entry will require a debit to long-term investments dash available for sale for $26,160, right? That's 1,000 times 26.16 per share. A credit to cash for $26,160, right? You got to pay for them, so that's the cash. So there it is. Long-term investments available for sale. So it's a stock, so yes, it could be sold, but you're not actually planning to trade it. It's available. We're going to call it available for sale. So you hold the stock for a while. Sometimes stocks pay dividends, sometimes they don't. So when a stock does pay dividend, we need to put that down on the books. So in our example, Yellow Corporation declares and pays a cash dividend of 16 cents per share on June 9, 2016. Smart Touch Learning will receive the cash dividend on June 9. So the entry requires a debit to cash, right? Cash coming in, 160, and a credit to dividend revenue for 160. 16 cents per share times 1,000 shares. So there it is, cash, dividend revenue. Pretty easy. You've probably heard of this. New York Stock Exchange, stocks buy and sell all the time. So when a company doesn't want to own a stock anymore, they just sell it, right? And they sell it for whatever the market is on that date. So we'll have to do something about that. All right, we may have a gain or a loss. It's pretty unlikely we'll sell them for exactly what we paid for if they're stocks that trade on a market. So for this example, on July 15, Smart Touch Learning sells their 800 shares of its stock for $25,000. Smart Touch compares the cash received with the cost of the stock and determines the gain as follows. All right, so the cash received was $25,000. The cost of it, they only sold 800 shares, so that those 800 shares cost, of course, $26.16 a piece. So the total cost was $20,928. So the difference between $25,000 and $20,928 means they gained $4,072. So that's a gain. We don't call that revenue, we call it a gain. On July 15th, they sell the 800, they compare it with the cost, the stock disposed, and determine the amount of the gain. So in this case, the gain is $4,072. So when we record that, we're going to record the cash. Of course, when we sell them, the cash came in. So cash, debit, $25,000. We've increased cash $20,000. The securities themselves, right? We put down the cost, $20,928. So long-term investments available for sale, the cost of them, the 800 times $26.16. And then the difference between that is the gain, or $4,072. The entry requires a debit to cash for $25,000. However, the investment account must be credited only for the cost of the 800 shares that were sold. Because the original cost was $26.16 per share, we can calculate the cost of the 800 shares sold as 800 shares times $26.16 per share equals $20,928. A credit will be made to long-term investments available for sale for $20,928. To get the journal entry to balance, a gain must be recorded to gain on disposal. Remember that gain on disposal is a temporary equity account and is reported in the other revenues and expenses section of the income statement. If the company had sold the stock at a loss, the account loss on disposal would be recorded as a debit. So let's talk about ratios we use when we're thinking about other companies. All right, so if you're thinking about investing in a company, what might you want to know about them? Well, one ratio might be the rate of return on assets. This is telling you how good a job they're doing using their assets. The rate of return on total assets is a ratio that measures the success a company has in using its assets to earn income. Net income plus interest expense divided by average total assets. There are two ways that a company can finance its assets. Debt. A company can borrow money from creditors to purchase assets. Creditors earn interest on the money that is loaned. Or equity. A company may receive cash or other assets from stockholders. Stockholders invest in the company and hope to receive a return on their investments. So, how do we use this? Well, let's look at an example. The rate of return on total assets is calculated by adding interest expense to net income and dividing by average total assets. So, for this example, you're using Green Mountain. Their total assets start out at $3,761,548. Then their ending assets are $3,761,000. Their beginning assets were $36,15,789, and so that's helping us come up with the average assets. You add those, divide by 2. That's their average total assets for the year. Interest income, $18,177, and net income, $483,232. So you take all those items and figure out the rate of return on assets, and it is 14%. Using Green Mountain Coffee Roasters, Inc.'s fiscal 2013 annual report, we can determine the rate. Green Mountain has a rate of return on total assets of 14, which means that for each $1 invested in the company's average assets, the company earned 14 cents in profit before considering interest expense. What is a good rate of return? There's no single answer because rates vary widely by industry. So a good thing to do is calculate rates of return over several years. Compare them back and forth, or compare competing companies. Invest in one that has a growing rate of return, or invest in one that has higher rates of returns than other similar companies. So that's why you would want to use that to see how well they're using their assets. All right, so that's going to complete class 29 for all you Monday, Wednesday, Friday folks. If you're a Tuesday, Thursday person, you still have some more for class 21. All right, see you later.